In August 1971, the U.S. government performed one of the most important financial moves in history. With a single television speech, President Richard Nixon ended a promise that had existed for generations. Overnight, the world's most powerful currency stopped being backed by gold. Most people barely noticed. But that decision changed the future of money, inflation, debt, housing prices, and the global economy forever. Under the Bretton Woods system, the world's major economies operated on a fixed exchange rate. Every major currency was pegged to the US dollar. The system relied on a specific guarantee. Foreign central banks held dollars because they knew the US Treasury would exchange those bills for physical gold at a fixed price of $35 an ounce. This convertibility acted as a physical limit on the global money supply. Governments could only circulate as much currency as they had metal to back it. In the decades following World War II, the United States increased its domestic and international spending. The government funded the rising costs of the Vietnam War and expanded social programs. To pay for these initiatives, the Treasury increased the supply of dollars circulating globally. By the late 1960s, the volume of dollars held abroad far exceeded the amount of gold stored in American vaults. The math of the Bretton Woods Agreement no longer held up. Foreign nations, led by France and West Germany, noticed the imbalance. They began requesting the promised physical gold, fearing the U.S. would run out. Between the years of 1950 and 1970, the United States gold reserve was effectively cut in half. The drain was accelerating. The U.S. faced a choice: drastically cut spending to maintain the gold standard, or break the promise and risk a global financial crisis. In August 1971, the crisis reached a breaking point as the British government requested to convert $3 billion into gold. On a Sunday evening, President Nixon addressed the nation. He had spent the weekend at Camp David with a small group of advisors, keeping the plan secret from the International Monetary Fund and his own State Department to prevent a market panic. Nixon announced that he had directed the Secretary of the Treasury to suspend temporarily the convertibility of the dollar into gold. He framed the move as a defense of the American economy against international money speculators who were draining the country's reserves. The suspension was never lifted. The fixed link between the world's reserve currency and a physical asset was gone. This created a system of fiat currency. Money was no longer a claim on a metal. Its value was derived from government decree and public trust. Money shifted from a finite resource to a ledger-based system. Its supply was no longer tied to how much gold could be mined. Central banks could now expand the money supply according to economic needs, lowering interest rates without physical restrictions. This led to a rapid expansion of the global credit market, as banking became centered on debt issuance and higher borrowing. By removing the gold ceiling, the government gained the power to intervene in the economy, but it also removed the primary mechanism that had historically limited inflation. Over the following decades, the disconnect from gold led to a massive shift in how wealth was measured and stored. This chart tracks total U.S. national debt. Following the 1971 unpegging, debt diverged from its historical trend, climbing sharply as the government borrowed against its currency. As the money supply grew, the dollar's purchasing power dropped, adjusting to the higher volume of circulating currency. This expansion of credit correlates with a rise in asset values. When the supply of money increases faster than the supply of houses or stocks, the price of those assets tends to rise. The shift toward a credit-based system has contributed to the current environment where asset ownership often grows faster than income from labor. Economists remain divided on whether this shift was a necessary evolution or a long-term risk. Proponents argue that the flexibility of fiat currency allows the government to prevent deep depressions by injecting liquidity when the private sector freezes. Opponents point to the widening wealth gap and the constant devaluation of savings, arguing that the system incentivizes debt over production. Today, the value of money is no longer found in a vault, but in the stability of the institutions that issue it. Whether the Nixon shock saved the global economy or created the foundation for modern inflation remains one of the most controversial questions in financial history. But one fact is undeniable. After 1971, money would never be the same again.